Hello, hello, hello. Happy June and happy Network at Noon. We are back. It's been about a year since we've done this, so I'm so excited to be back in the swing of things. If you don't know me, my name is Naila Jackson, the Network Navigator, and I am super excited to be here today. If you had a chance to come out and support us during Small Business Week, we had a little event called Network Navigator Day, and it was phenomenal. However, it tried to rain on our parade, and we had a slight, weather malfunction that caused us to have to end the day an hour early. So we had a couple of sessions that got cut, and we thought the best idea and the best way to recoup that time is to bring those special guests back with us during our yearly Network at Noon sessions that we have in June. So I'm excited today to have Josh Andrews, who is an attorney here locally in Birmingham, come back and talk to us about choosing the correct structure for your business. We're excited because those are questions that entrepreneurs have all the time. They don't know whether they should stay a solopreneur, whether they should be an LLC, an S Corp, a C Corp. They don't understand quite what the benefits are of each type of business structure. And so we've got Josh here today with us, and he is going to help us understand that. So I'm going to bring Josh on with us. Josh, you there?
I am.
Awesome. Well, I will let you take it away and go ahead.
Well, perfect. Well, thank you very much. As she said, my name is Josh Andrews. I am an attorney here in Birmingham. I've been practicing for going on 18 years now, doing this that I do. I work with small businesses and entrepreneurs to help them understand the legal that impacts their business every day. When I started my firm back in 2008, the idea was that I wanted to provide an education first approach to legal advice and services. And I wanted to make sure that you, the business owners, the entrepreneurs, understood the legal that matters in their businesses. And this is a really common topic that comes up on a regular basis, which is what legal entity do we need to use? What legal entity even matters as we're getting started? And I have this conversation all the time with business owners. I go in and we talk about a lot of things that matters. But at the end of the day, the legal entity structure is actually based on your goals and your desires and what you're trying to accomplish. So as we're looking at the legal entity that matters, what we're going to be looking at is the business model that you are trying to accomplish, what you are trying to do in your business. So we've got to think about a few different things when we first get started. Number one is, are you going to be offering a service or a product, right? Because there's some limitations that exist with a service business versus a product based business. Obviously, as a small business lawyer, I run a law firm that is a service business. As an aside, back in 2008, when I started my law practice, my brother in law gave me this great book that was written by a little known guy named Tim Ferriss called The 4 Hour Work Week, and was like, hey, this is really about building systems and processes in your business. I think it'd be great since you just started a company. So I started reading the book. And the first thing he says is, whatever you do, don't start a service business. Well, I did. And I already had, and I had, 3 years of student debt and a lot of education that went into the service business. But here we are 18 years later, still focusing on it. But a service business has certain kind of limitations and things that we deal with and approach on how you grow and what it necessarily looks like. A product based business is something that is completely different. Of course, now we even have kind of intellectual property products, right? So if you're kind of in the online space or something like that, we need to understand what you're doing because it could potentially impact your needs, because it can impact the team that you have, the ownership structure that you have, whether or not you're going to raise funds to build your business. And those things all matter in how you structure it. Then you need to go ahead and make the decision. Am I going to run as a solo, or am I going to have a team? and is that my goal on day one? And keep in mind, this is really important because I work with business owners, and I understand that what you think on day one is not necessarily what happens as things grow, right? But you want to understand kind of what you're thinking, because that helps you build your foundation as it develops. So if you're, yeah, I just want it to be me, it's just going to be me getting started, this is what it's going to look like, that is a different approach than if you were looking at growing a team or starting with partners or something like that, right? That really starts to matter. Then we also have to look at, are you a high volume work? Is what you're doing to gain a high volume of customers, of paying people, right? Think like food transactions or something like that. Or are you talking about a premium product, which means that you may need fewer sales to actually accomplish your end goals? And you need to kind of understand what you're looking for there. So we're going to talk about kind of three big things, right? Which is limited liability and why it matters at all. What kind of compliance programs and how we actually legally need to structure certain things as you grow, and then how does all of that translate into entity selection? So as we get started, we've got to understand what limited liability even means in the legal world, right? Limited liability, specifically talking about a legal entity, a limited liability entity. So an LLC, a corporation, even a nonprofit corporation, those types of things, is defined as liability of a company's owners for nothing more than the capital they have invested in the business. This is how the wealthy stay that way, because their liability is limited. So they start a company, they invest some money, they do the things that they're supposed to. The company fails or gets sued or something like that, you aren't on the hook as the owner for the personal issues associated with the business. We also need to understand that a legal entity is considered to be an organization with a legal identity separate from its members. So I often tell people it's not unlike having a child. When you form a legal entity, just like when you have a baby, what you're doing is you're spending all of your waking hours trying to make sure that that new organization with an identity separate from you stays alive, because it doesn't function or live without you. You feed it, you stay awake, you protect it, you care for it, right? It's not a company and a baby are really not that different as we're doing those things. And as the company grows, just like as the child grows, there's a certain level of independence that begins to develop, where it grows and it's able to take on a life of its own and structure. And even if you're a solo, that is built on systems and processes, so it continues to operate, without you necessarily being involved every single step of the way. And then hopefully one day, as you get into retirement, it's going to take care of you, right? And it's going to work accordingly. I often tell people that I have 5 children and 1 business, and I'm hoping something takes care of me in retirement, but they are not that dissimilar as we kind of work for it. So, what are the things that a business can potentially be liable for? What are we even worried about, right? Well, what we're worried about is issues of contract, right? You got leases, vendors, customers, right? Banks, loans, anything like that you sign a contract for is something that you as a business owner can be liable for. And if you're not careful how you sign that contract, and you don't sign it in your capacity as the member, the owner, the CEO, whatever your title is for that company, then you could personally have some liability there. If you sign a personal guarantee, you also may personally have some liability there. But those are one of the things that we're looking for from a legal stance, is to make sure that your contracts live within your company. The other is what's called a tort. These are kind of the legal lawsuits that you see, right? That's your slip and falls, injury to a customer, property damage, negligence, those types of things that a lawsuit kind of comes along, if you're a product company, those types of issues with the product itself, or something like that. The other real world kind of issues that we need to pay attention to, especially in today's world, is employment issues, data and privacy issues, regulatory compliance issues, and then of course debts and personal guarantees. So I hear all the time, especially in the service world. I speak to a lot of attorneys, helping them get their practice started, or even accountants and other professionals. Talk to a lot of doctors, and what I hear is an entity can't help protect me from malpractice, right? Which is kind of the general I gave bad advice, which is that kind of negligence thing. It's a personal issue, and technically that's correct, which is if you are not giving the best advice or something like that, there may be a personal issue associated with it. That, of course, is what insurance is for, to protect the actions of those who run the business. Because even though a business, a legal entity, is an organization separate from its owners, and a legal entity can only operate through its agents, which, especially in the early stages, are the owners. So we've got to be really careful to understand what that is. But an entity can help separate other liabilities. It can help separate business risk from personal risk. It can influence your insurance, your contracts, and even how you build your team. As an example of liability in this world, I often speak to some college students in their capstone senior seminar who are going into the healthcare industry. And one of the examples I often use, because they're the ones that I hear, well, I don't need a legal entity because it's a doctor's office and there's malpractice isn't protected. And this is one of the examples that I often use. Imagine you have a new patient who comes in and is going to come visit the doctor for the first time. And as they're walking in the building, the floors had recently been mopped by a staff member of the doctor's office, and they forgot to put the caution wet sign. And the guy slips and falls, bangs up his tailbone pretty bad. That's not the reason he's coming in, but it happens. And he stands up and he's okay. So he walks in to get everything signed, signed in, and he starts to sign all of his information, to sign over everything for his, to say that he's here and fill out everything. And that pen that's working somehow malfunctions and sprays ink all over his brand new Armani jacket. And then he's handed all of this paperwork covered, he's got a sore tailbone, he's covered in ink, and he goes to sit down in the little chairs that are all kind of connected, and chooses a spot kind of in the middle, and the whole thing collapses and folds on top of himself. And he is now underneath the chairs in the waiting room, attempting to fill out all of his paperwork. So he keeps going. He works on filling out all of his paperwork. He's finally called back by the nurse, and he starts to walk in to follow the nurse through the swinging door. And as he walks in, the door falls off his hinges, hits him in the head, and he passes out. When he comes to, still in the lobby, they're checking on him. He simply says, I'm going to go see a different doctor for these injuries, as well as the very reason I'm here. Now, and this is the point in my presentation where the slide slips up to Alexander Shunnarah and asks who we actually think he's going to get a call from. Once upon a time, it was Saul Goodman, but as Breaking Bad has moved further and further away, and we are in Alabama, sometimes Alexander Shunnarah is the answer. But at the end of the day, the point being that they haven't even seen the doctor for malpractice to happen, and all of these potential liabilities have come up. And those are the things that protect the doctor, the partners, all of their investment from their personal liability. So their car, their house, their retirement account isn't up for it. It's just the practice and what that looks like. So these are all kind of really important things. Where are some other possibilities where liabilities can come up without intending for those liabilities to come up? We can have an issue if we are a promoter, like if you were actually working with a group of business owners and you were actually working to get everything set up and you're doing all of this work, you can actually potentially have some liability before the legal entity is formed. And then another one is what we would have is a de facto partnership where you and someone else are working together to accomplish something, and you're sharing in business profits and losses, but you don't actually have a legal entity, and something happens and there's a world in which you may be required to share in those losses and those liabilities as well. So these are all things that we're trying to be really careful for. And so, one of the things we want to pay attention to is that if you're in the process of trying to build a lifestyle business and you're just trying to build something so that it's, either your side hustle or something else that you're working on, and you develop those things, then you do need to be careful of accidental partnerships, right? With working with someone without actually having a written contract in place to clarify what that may mean. So, as we look at these liabilities, the model choices, the things that you're trying to accomplish, those things actually impact your potential liabilities and what it necessarily looks like. So, if you're in the service business, you have some higher client specific risk plus relationship risk, as well as some potential issues, especially if you're in the kind of consulting, business of whatever variety, in the things that you say and making sure that you have appropriate disclaimers and things like that. If you're in the product world, you have to be concerned about some IP distribution support risks. What happens if the product isn't made well and who's responsible in that world? If you're a solo, you have fewer people who are making risks, but it's more of you. So the risk is on you messing up, right? Not on someone else. If you have a team, you have potential issues with HR, you have delegation, you have supervision that you have to pay attention to. You have to make sure that you're following employment laws and not messing up, that you understand the difference between an independent contractor and an employee. If you're in the high volume world, you have to be really careful to make sure that you can process failures, that you can understand that your process, if it fails, at scale, can create a major, major problem. I had a business colleague early on in my career who used to say, he was working on workouts and taking care of businesses and helping them kind of grow, and says, if you sell a product at a negative margin, selling more of your product isn't going to get you out of the hole that you're in. And so understanding what those processes, what those margins look like, can help you understand and protect and limit those liability. On the flip side, if you're in the premium market, if you're selling a premium service or product, the stakes and the expectations are higher, which means you may have some bigger issues on turnover if you're not paying attention. Which brings us, as you're building a business and you're structuring something, even if it's just you, into your processes and your programs and what actually makes sense. And you've got two different things that you're kind of looking for and paying attention to when you're building these types of programs. One is internal, which is how you do something, what it's supposed to look like so that you can repeat the things over and over and over again. I once interviewed a local entrepreneur who spends a lot of time working and developing and growing in his business. And one of the things, he's very focused on process. And he says that a good process can help you fail fast, but it can also help you succeed the same way. And so, as we're building internal processes, whether it's just you as a solo or you've got a team, you want a strong internal process for how you do the things that you do, because that's the only way you're going to know if it didn't work or something went wrong, what happened and how can you repeat it? Or if it went wrong, how can you not repeat it? And then you also have these external programs and processes, which is how do you communicate that with the outside world, whether that's your customers or your prospective customers or those on the other side. How do you kind of build those things to make sure that they work? So as you're kind of putting all of this in place, what does it necessarily look like, right? From a legal standpoint, it's something you've got to make sure that you put it in writing. That someone's paying attention. If you have a team, you're training people on it, that you're communicating what's going on and that you monitor it. Even if it's just you need to set up a process so that you're paying attention, so that you're looking at why things went a certain way and how they worked, right? So that you can enforce, modify, or change it to make sure that it works again. So now the thing that everybody actually really cares about, which is how do we actually make decisions on an entity selection? So we got a few different entities that you can potentially see and deal with. You've got the sole proprietorship, a partnership, a limited partnership, a limited liability partnership, a nonprofit corporation, a corporation, what we often call an S corporation, which is a tax election, not a legal entity, but it is often important to discuss in the small business world, and the limited liability company. So, how do you make a determination? How do you know what to choose? So, there's a few things that we're going to go through, but what I will tell you is that if you are unsure of the reason why, and you are starting a small business and you do not know what you should choose, the limited liability company is the lowest cost, highest yield investment you can make in your business because of the flexibility that exists and the changes you can make as you move forward. It gives you the liability shield and gives you the flexibility you need to move it forward as it needs to. So we got to understand a couple of things as we're working on some of these things to make sure that we understand how these things come into play. One is a tax concept. There is what is called flow through taxation, which means that taxes for the net profit of business are paid by the individuals. So basically, the earnings flow through. The corporation does not pay taxes. This is common in partnerships, which would be LLC's taxed as a partnership, and also that S corporation that we talked about. Then there's what is called double taxation, where C corporations pay taxes on their net earnings, and then shareholders also pay taxes again on dividends they received from the net profit of the business. So, like I said, a C corp is something that is common if you're going to use investors. You're going to have multiple classes of equity. You're looking for long-term growth and a potential exit, potentially in a public offering. A lot of times the problems that exist with a C corporation, especially when people move too early and they're not actually ready to do that thing, are that there's a lot of formality that you may not want to deal with in a small lifestyle business. And there's a tax complexity if you're not planning for reinvestment or exit or kind of reinvesting your profits appropriately. There's a tax complexity that can create a problem in the small business world. Which brings us to the S election for the corporation, which is a tax election often used by small businesses, which creates some limitations on the corporation while still allowing for the benefits of the limited liability. So the limitations you get are a limited class of stock, a limited number of owners. You're limited to a single type of class of stock, and it needs to be individuals who actually own the business. It's not something that is often favored by investors. So if you ever have this expectation of bringing on investors, an S election can potentially create some additional cost. It doesn't blow up the need for investors, but it can create some additional cost in the kind of administrative legal work that is necessary to get to that next step. It is sometimes a good fit when it's a lifestyle service business. You've got a stable level of profitability, and you, the owner, want to be on payroll with distributions to control some of your tax cost. And so there are some benefits. Often, those specific benefits are from a conversation with the CPA. I'm going to potentially raise money down the road, or I'm looking at these types of investors, or I want to offer an employee stock option plan, are things that are legal conversations to have about that entity before you talk to the CPA and make that election. Now, the LLC is, like I said, one of the most flexible things that exists. So a single member LLC, if it's just you, is basically taxed and structured just like a sole proprietorship, but you get the limited liability as long as you keep it separate, right? So you treat it as something separate, has a bank account, it makes money, you pay yourself, it all works the way it's supposed to. You have flexibility. And then as you grow and you make more money and you decide, well, it's just going to be me, it's a lifestyle business, you may elect that S election from a tax standpoint to benefit yourself once you kind of understand what's going on. And so as you're kind of moving into a world like this, the capitalization, how you're putting money into, can actually affect that entity selection as you're dealing with those particular things and issues. So as you're looking at something like that and you try to understand what's going on, a bootstrapped service or premium model capitalizes differently than, say, like a product and scale model. Investor money, if you're bringing it in, can change governance and control, reporting, and exit expectations. Ultimately, so I'm going to give you this kind of example to kind of break some of these things down, and then hopefully we can get to questions if you guys may have them. But stuff like this happens to me all the time, where we've got a couple of partners who are coming in, they want to get started in something. One's older, been around in business for a little bit longer. One's younger, is eager to jump forward and move on. So let's say that we get started and this older partner has $50,000 that they're ready to invest in the business. And the younger partner has $10,000 that he has ready to invest in the business. And they both, of course, want to split everything 50-50, which happens all the time. Well, it doesn't take a math genius to understand that it's not equal, right? If we're looking at that, it is not actually an equal number. And if they want to split everything equal as $10,000, right? So each of them put in $10,000, but say what we need is $60,000, right? So how do we deal with that other 40%? Well, if it's an S corporation, you're really limited because the investment, the equity actually matters. It has to be pro rata on the distributions. They have to be structured the same. If it is a C Corp or an LLC, you can use preferred or different economics for the way that owners are treated. But at the end of the day, their goal is to be treated 50-50 and they want to be structured a certain way. So sometimes what we actually have to do is make them invest that money equally and then take that extra money and turn it into debt for the business, where the one who has the money becomes a creditor and loans that money into the business. So our partners are 50-50, but the other one has actually loaned this certain amount of money into the business to make it work. Now, there is a slight nuance if the partner who doesn't have a lot of cash came up with something that has a lot of value, some intellectual property, a software or something like that, and they're putting that in, then we may be able to make them equal. But all things being equal, we need to make sure it's right and the same, because if we actually look at the economics not being equal, it can create problems down the road when things are shut down and they are structured a different way. So one of the final things that really goes into that LLC structure or development, or I mean the legal entity structure development, are the way that they're actually governed. So a corporation, even an S corporation, is supposed to have a board of directors, annual meetings, some delegation issues. You got to understand what's going on. With an S corporation, you can set it up so that it's very limited who's actually in control, what the board looks like, but you need to make sure that it's adequately documented so that the IRS doesn't look at everything and go, wait, you're not doing what you're supposed to. Therefore, we revoke your S election and now you owe all these taxes. The LLC, on the other hand, has some flexible management and delegation. It can be managed by the partners in a certain way. You can make decisions in a certain way. I also deal with this as if we are not the same from a kind of equity standpoint. So maybe we're 60-40 or something like that. In an LLC, we can structure the management to be equal if that's actually what the partners mean. So you can actually have these decisions, equality in your decision making without creating something in a different way. And so without dealing with the equity, they don't necessarily have to be the same in the LLC. So as we kind of look at that, it's really important to understand that a lot of times I have clients coming to me saying, well, one of us needs to own at least 51% so someone can make can break the tie. Well, that may not actually be what you meant. So instead, let's actually look at figuring out how to break the tie if that's a real issue that we're kind of looking at and dealing with. So as we kind of build out, I'm happy to kind of take any questions and talk about those things, but I really kind of wanted to break a lot of this stuff down so that you can understand that there's a lot of kind of thought process that has to go into how we actually deal with and structure these specific entity selections and deal with what's going on as we kind of structure and set up your small business as it works. But I'm here and happy to talk and chat on any additional questions that you may have.
All right. Can you hear me, Josh?
Yes, I can.
Okay, good, good, good. We had a couple of questions that came across on Instagram. How does your business structure impact access to capital and loans?
Okay. Those will be technically kind of two different things. So capital can be, someone investing money as an investor, right? As an equity investor. Capital can also obviously be a debt instrument. Typically in the early stages of a business, the access to capital from a debt standpoint is based on the founder and their personal capital. That's one of the places where, especially post COVID and things like that, there's probably going to be a personal guarantee if you're under 2 years old, and you don't have a lot of kind of information there. And so that's going to be based on the business owner and their personal credit. From an investment standpoint, if we're looking on bringing on investors, equity investors, there's a lot of impacts that can happen there. And that's that S election has a limitation on the classes of who can own, the types of owners that do exist. So a lot of times investors they're going to have like an LLC investment vehicle or something like that. They can't own an S corp. They're going to want some preferential treatment. That can't happen in an S corp. So it really has a huge impact on you. Whereas the LLC, there's a lot of flexibility that exists. And then depending on your growth level, the C corporation becomes something that a lot of times they're actually looking for.
Wonderful. And then I have one more question from over there. What signs tell a business owner they've outgrown their current structure outside of revenue?
Okay. The again, like, so if you're like a solopreneur who's got an LLC that's taxed as a sole proprietorship, one of those is your self-employment tax is growing. So it's technically based on revenue, but it's really the net profit. So what happens is if you start making so much money, and this is true for LLCs taxed as partnerships and LLCs taxed as sole proprietorship. So whether you've got one partner or it's just you yourself, if you start making so much net profit and you break the kind of $150,000 a year in net profit world per partner, then what happens is that you continue making the self-employment tax, which is an uncapped number. But self-employment tax is something that's actually designed to look and feel like your FICA Medicare tax, right? So it's just taxed on business owners. And that's the point at which we start looking at the S election for these business owners and whether or not it makes sense from a strategic standpoint, because we're able to move the business owners to where they can make a salary and then also take distributions, which kind of controls the tax that can potentially exist. So that's one that's really important. But then the other is if you are kind of growing and you begin to understand, say you started out as a solopreneur, you formed an LLC, you built this kind of technology product and you just like you hockey sticked, right? And everything's going great the way that you want it to. And it looks exactly the way you want it to. And now you're like, oh, well, I need to grow and I need to build my team. So I need to get some investment. You probably need to look at your structure first before we start going to bring on investment, because you've got to make sure that it's set up to take that on. And so as you're moving into that next level, it's a really a good chance to kind of have that conversation. And then anytime you're looking to bring on a new partner, or say you've got staff and you want to offer some kind of stock options or something like that, it's always important to look at whether your current legal entity structure matters. But you can't kind of flip back and forth on entity, especially tax structures. And so it's really important. That's why I kind of point out the legal questions and the accounting questions, is you want them to go together, because you don't want to make a tax election that makes sense in this tax year, but blows up your investment plans later.
And I think that's one of the biggest things. And now this is just me talking. I think that's just one of the biggest things that I think entrepreneurs need more education on, is understanding where the threshold is, right? Because there is this polarizing campaign of get an LLC, get an LLC, you need an LLC. And when you get an LLC, all your problems are solved. You can do, you're protected. And so my question for you, and this is the last question, and this is one of my questions that I think would be helpful. Where does that limitate, how much limitation does an LLC provide, right? Or how much protection, I'm sorry, does an LLC provide? Because that is the story that they tell on the internet and TikTok and all of that. They talk about you just get an LLC. It's so simple. First of all, it's not that simple. There are some tax liabilities that go with it that will pop up from your state. As well as the federal government, if you don't handle your taxes and your 990s and all of those things, especially when you're talking about a nonprofit. But you can't just up and elect a structure and not understand what legalities go along with it. So when we're talking about an LLC specifically, what protections does it technically offer?
So an LLC provides the limited liability protection that like the corporation provides, right? So it give as long as you structure it and handle it right, and that's the part that TikTok ignores, right? Which is so there's a few things that go into it. You can form an LLC, but if you don't kind of separate the assets, the business assets from the personal assets, it doesn't matter. And what's going to happen is the veil is going to be what's called pierced, and they're basically going to say, well, you didn't really have an LLC, it didn't matter. So from a liability standpoint, if structured properly, it provides you all the protection you need. But it also provides you all of the flexibility that you need, which is one of the reasons it's become such a big deal, was because the LLC, the advent of the LLC was to solve a small business problem. And that small business problem was it was really expensive and complicated to form a corporation. And sometimes it created more problem than the liabilities it was trying to avoid. So you spend all this money to never get sued, right? And the whole point of limited liability is if you get sued, your whole life doesn't shut down. But an LLC is a lower cost option with less kind of red tape and structure associated with it, so that you can do that as long as you kind of follow the rules, right? Which is, again, go get a business bank account. The money that you make goes in that bank account. Business expenses are paid out of that, and then pay yourself out of that net profit, and all should be good. And then you've got that flexibility as you grow and change to make those adjustments within it.
Awesome. Thank you so much. Well, Josh, that's all I have on the question side. I thank you so much for your time today. And we'll be looping and playing this and sending it out. So we're going to bleach you out all over our network. But thank you so much for taking the time to explain that to us. Like you said, you get a lot of questions about that, and we do too here at Network Navigator when we're talking to new entrepreneurs and people who are interested in getting into entrepreneurship. And I think that now is as good a time as any to talk about this, because with all of the things that are happening in our economy, as far as layoffs and things like that, there are a lot of individuals who are forming businesses out of necessity. And so they need to understand, as they're forming these businesses, what is the best structure for them? What is the best route for them to save themselves the red tape, the headache, the frustrations, and things that come along with it once the business is formed and the year ends and it's time to file taxes? What do you need to do? If you're going to be adding employees, or you're going to have, public stock, like what is the formation you need to take? So I think this is a great timing for this conversation. And I thank you so much for having it with me, Josh.
Well, thank you so much. I look forward to helping if I can help anymore.
Will you drop them your contact information before you go?
Yeah, absolutely. You can reach me, Josh at gatehouse.law is my email. Probably the best way to get in touch with me. That's JOSH at gatehouse.law. And you can also call my office, 205-208-9595. And I'm happy to get back in touch with you.
Awesome. I'm dropping that information into the chat. And if they blow you up, it is not my fault.
That's perfect. I look forward to it.
All right. Well, thank you guys so much for joining us for our first Network at Noon of 2026. We look forward to seeing you next week. And until then, bye.
Bye.